Welcome to an introduction to accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. This is the second podcast about adjustments that may be needed at the year end. Revenue accruals arise where a good or a service has been provided but the revenue has not been received or recorded. An order may have been placed and the goods shipped to the destination, but no payment received. Some entities will always have ongoing work that needs to be recorded. This includes lawyers and solicitors who may have hours worked for clients that are still unbilled. It can also apply to construction firms with partly completed work. The procedure will be to debit trade receivables and credit revenues at the end of the period to reflect the accrued revenue. Other revenues that might need recording are interest income and dividend income. Expense accruals are incurred where the expense has not been paid for services or goods received which were used in the business. Utilities bills are often received after the end of a period, but the accrual still needs to be entered. If electricity costs have been incurred, then the electricity expense must be increased and a liability for the expense increased at the end of the period. Other possible accruals expenses include tax, interest, and wages. We will consider an example of an accruals expense. A utility bill for £300 is received but has not been recorded. The utilities expense currently stands at £21,000. What entries are needed? The utilities expense needs to be increased by £300 to £21,300. This is done by a debit to the utilities expense account. The current liabilities accounts will also need to be increased by £300. A credit of £300 is required to current liabilities. We will do one more example for you. The trial balance shows that tax payable expenses currently stand at £12,000. However, it is estimated that the total taxes at the end of the current year will be £20,000. What are the adjustments that will be needed to the accounts? The current entry for taxes payable is £12,000 and the expected taxes payable is £20,000. So an increase of £8,000 is needed to the tax payable expense. The tax payable expense will be debited with £8,000. Since an expense has been increased, it will affect the income statement. Net profit is going to be reduced by this amount. Current liabilities will need to be increased. We credit current liabilities with £8,000. This will affect the balance sheet. Expenses may sometimes be paid in advance than the total expense initially recorded as a debit to the expense account. Insurance companies will require payment in advance for vehicles insurance and property insurance, and usually most other forms of insurance. At the end of the year, some of that expense may not have been incurred, and this amount must be removed from the expense account. The amount removed will represent an asset and is recorded in an asset account for prepayments. Let us work through an example to illustrate this. A year of insurance is purchased on August the 1st for £24,000 and is recorded in the expense account for insurance. At the end of the year, on December the 31st, how much expense had been incurred? To work this out, we first need to know how much insurance has been paid each month. So we divide £24,000 by 12, which gives us a figure of £2,000 per month. From August to December is 5 months, so we have 5 months' expense, and the remaining 7 months is an expense for the following year. This must be reflected in the accounts. We deduct £14,000 from the insurance expense, which means we need to credit that account with £14,000. We then debit the asset account of prepayment with £14,000. Any business that offers customers credit terms can expect to incur some bad debt. If there is no bad debt, then the business may be losing some sales as a result of being too cautious. Bad debts are regarded as a cost of doing business. Credit requirements for customers should not be so strict that they act as a deterrent for customers, or potentially profitable customers may be lost. An entity should make a provision for doubtful debts. A doubtful debt provision is an estimate of the amount that will not be collected in payment for goods and services supplied. It reduces the trade receivables to net realizable value. The net realizable value is the amount that can expect to be collected by the entity. A bad debt becomes an expense of the entity and is reported on the income statement. To account for bad debt at the year end, the entity will follow a simple procedure. At the year end, the bad debt will be estimated. Some accounts will be written off, and the provision for doubtful debtors will be adjusted by reducing it. An estimate is then made of the amount that will not be collected from other customers. This estimate is based on experience and on the aging of accounts. Typically, it is a percentage of trade receivables. The provision for doubtful debts is increased to reflect the amount estimated to be uncollectible. Let us work through an example for bad debts and doubtful debts. An entity has trade receivables of $620,000, and the bad debt to be written off is $20,000. The estimate for doubtful debt provision is 10% of receivables at year end. The doubtful debt provision at the start of the year was $35,000. So we start with the trade receivables, which has an initial balance of $620,000. And we know that we are going to write off a figure of $20,000 for bad debts. This will reduce the trade receivables to a figure of $600,000. We now calculate the doubtful debt provision at 10% of the $600,000. This comes to a figure of $60,000. We already had $35,000 as the figure for doubtful debts. However, we have written off $20,000. That leaves us with a figure of $15,000 as the provision so far. So this year we estimate the provision needs to be $60,000, and therefore we need to increase the provision by $45,000. Now we need to record the provision. Firstly, we have reduced the balance sheet for trade receivables to $540,000. And secondly, we have a bad debt expense of $45,000 on the income statement. Why should we be making a provision for a doubtful debt? Accounting is being done using the accruals concept and the matching principle. If we waited, then the expense would not be in the same period as the sale, and the matching principle requires that expenses are matched to sales. The net income would be overstated if we did not do this. We also need to record assets at the lower of cost or net realizable value. Trade receivables records an asset of the entity, and making the provision for doubtful debt reduces the trade receivables to net realizable value. This means that on the balance sheet, the trade receivables reflects an amount that can be expected to be collected. This ends our second podcast on adjustments, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.